This is Group 6. Welcome to our presentation on strategic analysis of Standard Bank in South Africa's financial services industry. My name is Precious Kisako, and today I'm joined with my talented group members who are Esther Mutano, Seth Maingi, Eugene Kariuki, Jess Karanja, Victoria Gitire, and Faith Korir. Today we will explore Standard Bank's strategic position in Pestel, Porter's 5 forces, and 4 corners framework. Let's dive into it. Analysis of Standard Bank in South Africa's financial services industry. The first, sorry. So, uh, financial services in South Africa is actually a critical pillar of the national economy that that covers a lot of things, including banking, insurance, and investment services. It was established in 1962, and it's actually one of the top Africa's financial institutions. It actually operates in 20 African countries with a strong base in South Africa. So our analysis today uses 3 strategic tools, which include Pestel, Porter's 5 forces, and the 4 corners model. Let's get into the Pestel analysis. What is Pestel? So Pestel helps us examine 6 external factors, which include political, economic, social, technological, environmental, and legal, which affects a company's strategy. So for Standard Bank, this tool helps identify the external challenges and opportunities shaping its decision in South Africa's financial sector.
Hello everyone, my name is Esther Mutanu and I'll be taking you through the political factors that affect the Standard Bank in South Africa. So in a Pestel analysis, political factors refer to how government policies, regulations, and political stability impact a business environment. So let's delve into it. South Africa's financial sector is heavily regulated by institutions such as the South African Reserve Bank and Financial Sector Conduct Authority. So this institution or other institutions help to enforce compliance through laws such as the Financial Advisory and Intermediary Services Act, as you can see in our next point. So this imposes stringent compliance requirements and thus increases operational costs for Standard Bank as they must comply with these laws and regulations. However, the government initiatives promoting financial inclusion provide opportunities to expand services to undeserved communities. So this presents opportunities for Standard Bank to expand their customer base, especially among the previously unbanked areas. So for instance, Standard Bank has introduced low-cost transactional accounts to align with these policies, and though this will require significant investment in outreach programs. To our next point, economic factors. So in Pestel analysis, economic factors are, or rather refer to how the overall economic conditions and trends, such as inflation, interest rates, and exchange rates, affect a business environment. So these factors influence the customer's purchasing power, the cost of capital, and things to do with investment decisions, and also the business performance. And in our case, for banks, like the Standard Bank, economic conditions directly impact loan demand, credit risks, and factors such as profitability. So in South Africa, the economic growth remains sluggish, with a GDP growth forecasted at 1.2% for 2024. This is in accordance with the information that was given by the South African Reserve Bank in 2024. So the impact in this, it's that it has limited economic growth by reducing the overall business activity, which in turn lowers the demand for banking services like loans and investments. So to our next point, which is high unemployment. According to statistics, high unemployment exceeding 30%, it constrains consumer spending on financial products, heightening demand for affordable banking solutions. So the unemployment rate in South Africa is about 30%, and it's one of the highest globally. And the impact on this is that it significantly limits consumer spending and reduces people's ability to afford premium financial products, pushing banks to focus on affordable and basic banking solutions. To our next point, the current volatility with the rand fluctuating against major currencies affects Standard Bank's international operations and profitability. So this is in accordance with the factor exchange the exchange rates, whereby the impact on this is that it affects Standard Bank's international operations, their foreign investments, their profitability, and especially in the cross-border transactions and trade finance. And lastly, the economic stabilization efforts create potential for increased lending and investment services. So despite challenges that we have seen, the government-led efforts to stabilize the economy are also ongoing, and these efforts create potential opportunities for Standard Bank to increase lending, to offer investment products, and to also support infrastructure or development projects. So I'll also take you through the social factors, and we'll start first by defining how social factors are defined in PESTEL analysis. So social factors refer to the influence of societal trends, demographics, cultural attitudes, and consumer behavior on a business. So this includes factors such as population growth, the age distribution, the educational levels, the lifestyle changes, and also the preferences for the different consumers. And for standard banks, or rather for banks, the shifts in the customer expectations, the growth in the youth population, and the demand for digital services, they all shape how products and services are developed and delivered in this sector. So we can take a look at how the social factors affect Standard Bank in South Africa. So South Africa's diverse population exhibits varying levels of financial literacy, necessitating tailored financial products. So in short, the South African's population is socially and economically diverse, and with significant variations in financial literacy. So this has an impact on the Standard Bank, whereby the bank must offer tailored financial products that cater both the financially savvy the financially savvy clients and those who require more basic, easy to understand services. Over to the next point. Urban tech savvy customers demand digital banking solutions, while rural communities require accessible basic services. So the impact on this on the bank is that it requires Standard Bank to balance high-tech platforms such as mobile apps, while community-based outreach and simplified service delivery. So they have to do outreach programs to reach those people who are not tech savvy, so that they may be able to simplify their service delivery. The Standard Bank also addresses these needs through its mobile banking platforms, such as the Standard Bank Connect and the Community Financial Literacy programs. However, customer dissatisfaction, such as complaints over high banking fees in 2022, highlights the importance of responsive service strategies. So this highlights the need for responsive and transparent service strategies in the bank in order to maintain trust and improve customer satisfaction. That's all from me. Thank you.
With social dynamics in mind, let's explore technological factors. Rapid technological advancements are reshaping financial services. First up, the financial world is changing fast. New tech is completely reshaping how banks like Standard Bank deliver services. It's a game changer in seeing ahead. It's non-negotiable. We also have the increasing adoption of smartphones drives demand for mobile banking. So with Standard Bank Connect, their online app, it has enhanced customer accessibility. I mean, think about how much we all use our smartphones. That trend is driving a huge demand for mobile banking. So Standard Bank has leaned into this with Standard Bank Connect, a platform that lets customers bank on the go, making life easier and more accessible for millions. However, competition from fintech firms offering cost-effective, user-friendly services poses a threat, because there's a catch. Fintech companies are stepping in with cheaper, user-friendly options. I mean, imagine a new app that's super easy to use and charges almost nothing. Those competitors are a real threat to Standard Bank, pushing them to innovate constantly. And lastly, we have cybersecurity, which is very critical. So as data breaches could undermine customer trust, requiring substantial investment in securing infrastructure. And with more banking online, cybersecurity is a big deal. A single data breach could make customers lose trust in Standard Bank, something they can't afford, so they're investing heavily to secure their systems and to keep the data safe, even though it's a costly effort. So let's connect this back. Technology is an opportunity for Standard Bank to grow, but it also brings risks they need to manage carefully. From technology, it has both opportunities and risks. Now, what about environmental factors? We have growing emphasis on sustainability compels banks to adopt environmentally responsible practices. I mean, sustainability is a hot topic right now. The banks are under pressure to go green. So for Standard Bank, this means adopting practices that help the planet. It's not just a trend, it's a must. That's how Standard Bank has allocated 10 billion rand to green financing, supporting renewable energy projects by 2024. So here we are seeing, I mean, Standard Bank is stepping up in a big way. They have committed 10 billion rand to green financing. That's funding for renewable energy projects like solar, wind, and they have already hit this goal by 2024, according to their latest report. I mean, it is really a bold move towards sustainable future. Climate-related risks such as droughts impacting agricultural clients affect loan repayment rates, necessitating robust risk management. So from this statement, we also see the environment also brings its own challenges. Climate issues like drought hits farmers hard, and many of them are Standard Bank's clients. So when crops fail, they struggle to repay loans, so the bank has to get smart about managing these risks to stay financially stable. Lastly, we have these initiatives enhance Standard Bank's reputation but increase operational costs. So going green boosts Standard Bank's reputation. People love a bank that cares about the planet, but it's not cheap. This initiative increases cost, and Standard Bank has to balance that while keeping services affordable for customers. So environmentally, Standard Bank is making strides, but they've got to juggle the cost and risks that come with it. Let's wrap up our pastel by looking at legal factors. So we have the compliance with regulations like the POPIA, that's the Protection of Personal Information Act, and anti-money laundering laws, which are mandatory. I mean, of course they are, because Standard Bank has to follow these rules, like the POPIA, the Protection of Personal Information Act, and the anti-money laundering laws. These aren't optional. We also have an explanation that these laws protect customers but require significant resources for data protection and compliance system. These laws are great for protecting you, the customer, by keeping your data safe and preventing financial crimes. But for Standard Bank, it means spending a lot on data protection and compliance systems. Think of it as a cost of doing business the right way. Non-compliance risks have severe penalties, making legal adherence a priority for Standard Bank. And if they don't comply, of course, you receive penalties which are harsh, fines, legal troubles, and a damaged reputation. That's why legal adherence is a top priority for Standard Bank. They can't afford to slip up. So now let's bring it all together. The PESTEL analysis has shown us that Standard Bank is navigating a complex landscape. And politically, they're dealing with heavy regulations, but also opportunities to serve more communities. Economically, a sluggish economy and high employment creates challenges, though stabilization efforts hope for growth. Socially, they are meeting diverse needs with platforms like Standard Bank Connect, but customer satisfaction needs attention. On the technological aspect, mobile banking is a win, but fintech companies and competitions, cybersecurity keep them on their toes. Environmentally, their green initiatives are reputation boosts. Despite the cost and climate risk and legal compliance, it's a non-negotiable to avoid penalties and maintain trust. So what does this mean for Standard Bank? They're in a strong position as a market leader, but they can't rest. To stay ahead, they should always keep investing in digital banking, expanding affordable services for underserved communities, strengthen their sustainability efforts, and ensure they're always compliant with the law. So by enhancing these challenges and opportunities, Standard Bank has and will continue to thrive in South Africa's financial industry.
My name is Faith Korir, and I'll be taking you through the analysis of Standard Bank using Michael Porter's 5 forces. We will look at the competitive landscape of Standard Bank in South Africa. So, Michael Porter's 5 forces analysis is a powerful tool for understanding the forces that shape competition within an industry. It has 5 dimensions. Threat of new entrants, bargaining power of suppliers, bargaining power of buyers, threat of substitutes, and rivalry among existing competitors. This framework also helps us understand how strong a company, in our case Standard Bank, is against its competitors, potential new entrants, and other market pressures. So we're going to look at how these factors impact Standard Bank's overall strategy. We're going to start with threat of new entrants. So chances of new competitors entering the market is low because there are high entry barriers. So think of it like this. It's tough for new banks to get in the game in South Africa. There are big hurdles like needing a lot of money to start and getting the okay from South African Reserve Bank. Also, Standard Bank has a strong brand. It also has lots of branches and customers who trust them, which makes it even harder for newcomers. However, digital-only banks like TymeBank, which requires less physical infrastructure, represents an emerging threat, which necessitates ongoing innovation for Standard Bank. The second factor is bargaining power of suppliers, and this is basically how much power do suppliers have to raise prices. And with regard to Standard Bank, it's moderate. So Standard Bank relies on various suppliers like tech companies, payment networks, for example, Visa and MasterCard, and also skilled workers. Tech companies, they don't have too much power because Standard Bank can choose from the many available providers, which puts Standard Bank at a leverage as they're able to negotiate favorable terms. However, because there's a lot of unemployment, employees don't have as much power to negotiate. Overall, the power of suppliers is balanced but requires careful management.
My name is Victoria Gitije, and I'll be taking you through the last 3 dimensions under Michael Porter's 5 forces model. I'll be starting with the bargaining power of buyers. So bargaining power of buyers basically means that buyers have an upper hand in the industry, therefore they can be able to control it due to low switching costs. Switching costs are costs of moving from one product to another, or one service to another, or in our case, moving from one service provider to another. For example, when a customer moves from Standard Bank and opens a new account in Absa Bank, the customer would incur termination fees and also fees of transferring his or her money from Standard Bank to Absa. This is greatly accelerated by the fact that rival banks exist, hence enabling the customers to demand lower fees and enhanced services. And if the bank fails to honor what the customers really want, the customers end up moving from that particular bank to another, hence Standard Bank will lose its customers. Standard Bank therefore tries to mitigate this through loyalty programs and digital banking enhancements such as biometric authentication and issuing of virtual debit cards. Next would be the threat of substitute products. Substitutes in this case include fintech platforms, for example, PayPal and Venmo, mobile money services, which enable a person to transact their businesses online wherever they are just by the use of their phone, and also informal financial systems such as community saving groups where people come together to save money collectively, and also people can be able to get loans from the groups from the pool of money that is collected. Fintech firms offer cost-effective and user-friendly alternatives which are attractive and appealing to younger demographics, meaning they don't end up opening accounts with banks. So Standard Bank tries to mitigate this by introducing and coming up with robust digital channels which are highly reliable and user-friendly for its customers, and also they try investing and continuous innovation in order to attract new customers, diversify their customer base, and also retain the customers that are already in existence. Lastly will be rivalry among existing competitors, which is really high for Standard Bank since the industry is highly competitive. The key competitors of Standard Bank in South Africa are Absa, FirstRand, and Nedbank, which compete aggressively in terms of their pricing of their packages, digital innovation, and also how they handle their customers. So Standard Bank introduced low fee accounts in an attempt to match its competitors. They also try to cope with the competitiveness through differentiation of the product that they are offering, which they do through the use of superior technology, which is attractive not only for younger demographics but also for everyone in general, since we are all moving towards a more tech-driven world. Lastly, Standard Bank also tries to improve its customer experience, which is one of the biggest attractions that actually makes customers choose and stick to a specific brand. That will be all from Michael Porter's 5 Forces.
So my name is Eugene Njogu and I'll be taking over from Victoria. So we're going to learn about the four corners analysis. What is the four corners analysis? This can be described as a framework which predicts a competitor's future strategy by analyzing their drivers, management assumptions, strategy, and capabilities. So in our case, we'll be analyzing Absa, which is a competitor for Standard Bank. Let's start with the key drivers. Absa is focused on enhancing profitability and expanding its market share both in South Africa and across the African continent in countries like Botswana, Ghana, Kenya, Mauritius, Mozambique, just to name a few. The bank is positioning itself as a leader in sustainable financing and digital banking, with a strong emphasis on improving customer experience. Notably, Absa is aiming to become the least complained about bank among South Africa's big 5 banks. So from all this, we can see that the key drivers for Absa are to enhance profitability, expand market share, sustainable financing leadership, digital banking, and superior customer experience. So next we'll be going through management assumptions. Absa's strategy is based on several key assumptions. First, we can say they expect the continued rise in smartphone use is going to sustain the growing demand for digital banking. This is due to the convenience brought about by smartphones. Second, the management anticipates a moderate economic recovery in South Africa, with GDP growth projected at 1.1% for 2024. In contrast, stronger economic growth is expected across the rest of Africa, with regional operations projected to grow at a GDP-weighted rate of 4.8%. And finally, Absa expects increasing competition from fintechs. And for those who don't know what fintech is, fintech means like new technology that seeks to improve and automate the delivery and use of financial services. This means that ongoing investment in technology will be essential to maintain its competitive edge. That says against Standard Bank. Yeah.
Hi, my name is Joyce and I'll be taking you through the other points. So we have strategy. Absa employs a differentiation strategy emphasizing on digital innovation and sustainable financing. What this means is Absa is not competing on price alone. It has set itself apart by offering a unique and high-value service, especially on digital innovation and sustainable finance. This has impacted Absa by winning over tech survey customers, young professionals, and investors interested in ESG compliance and groups that are increasingly influential. The bank has integrated its retail units into a single retail banking unit to accelerate the growth, leveraging platforms like PayShap for low-cost payments. What this means is Absa has unified its retail operations under one umbrella, simplifying its structure. This has impacted them by customers benefiting from faster services and seamless digital physical banking, and internally it enables data sharing and analytics for better cross-selling and risk management. Absa's sustainability-linked financing reached 42.6 billion rands in 2023, including 31 billion rands for renewable energy projects, positioning it as a leader in green finance. Additionally, Absa targets small and medium enterprises with tailored products to capture these growing segments. Another point, we have capabilities. So Absa boasts strong capabilities, including a robust digital infrastructure and a well-recognized brand. What this means is Absa's digital backbone supports mobile apps, online banking, and automation of services. This has impacted them by enabling Absa to compete with fintech disruptors, lower customer acquisition cost, and increase efficiency in customer onboarding and service delivery. Its financial strength, with headline earnings of
10.2 billion rands in the first half of 2024 supports investments in technology and sustainability. This means that their strong earnings have attracted investors and enabled Absa to handle regulatory shocks, interest rate hikes, or credit defaults better than weaker competitors. Absa's diversified operations across 16 countries provide resilience, but its heavy reliance on South Africa, where economic challenges persist, present vulnerabilities. The bank's leadership in sustainable finance and digital banking enhances its competitive position, though continuous innovation is required to maintain this edge. So, conclusion from our research is that from the PESTEL findings, the key challenges that we found is that Standard Bank operates in a highly regulated environment with frequent policy shifts, while economic instability, including inflation, load shedding, and unemployment, adds further complexity. Social diversity and inequality require banks to be inclusive and adaptive in service delivery. So, for the growth opportunities, the rise of digital transformation, fintech partnerships, and ESG-focused financial products open the door for innovation. Standard Bank can leverage these trends to reinforce its leadership in sustainable banking, especially as green finance becomes a national and global priority. From the Porter's 5 Forces analysis, we found that for the industry structure, the banking sector faces high customer bargaining power, intensified competition, and substitute threats from fintechs and mobile money platforms. So they have the high buyer power, there is intense slavery, and emerging substitute threats characterize a competitive industry, but Standard Bank's established position and technological investments provide resilience despite the challenges. For the 4 corners findings, Absa's focus on digital innovation, sustainable financing, and customer sincerity positions has acted as a strong competitor, challenging Standard Bank to enhance its digital and retail banking offerings. What this means is that the competitor focus for Absa is that it is emerging as a formidable competitor driven by a differentiation strategy that emphasizes on digital innovation, green finance, and SME engagement. And the customer-centric and sustainability-driven approach is reshaping the market expectations. Focus on the digital innovation, sustainable financing, and customer sincerity positions it as a strong competitor, challenging the Standard Bank to enhance its digital and retail bank offerings. For the strategic recommendations, to sustain its market leadership, Standard Bank should implement the following strategies. Enhance digital banking. They should develop Standard Bank Connect to improve user experience and accessibility, countering fintech and Absa's digital advancements. This means that they should invest further in Standard Bank Connect and other digital platforms to enhance user experience, functionality, and accessibility, especially on the mobile channels. Another point is expand financial inclusion. They should increase investment in low-cost banking products and financial literacy programs to reach undeserved communities, strengthening the customer loyalty. This means that they should scale up low-cost banking solutions, e.g. simplified accounts, mobile banking bundles, and launch financial education initiatives in undeserved and rural communities. They should also strengthen the sustainability initiatives by expanding the green financing, building on its 10 billion rands commitment to align with environmental regulations and enhance brand reputation. This means that they should expand beyond the current 10 billion green finance commitment by offering sustainability-linked loans, green bonds, and ESG advisory services. This will enhance their brand image, attracting ESG-conscious clients and institutional investors, and future-proofs its lending portfolio against regulatory and environmental risks. They should also counter Absa's strategy, bolster digital branding, and explore strong fintech partnerships to match Absa's innovation, particularly in the banking and SME services. This means that they should increase their digital branding efforts and pursue strategic partnerships with fintechs to accelerate innovation, particularly in the retail and SME banking. This will enhance their competitiveness in high-growth segments, position Standard Bank as an agile and innovative, and strengthen its hold on SME ecosystem, which is vital for South Africa's economic recovery. That will be all. Thank you.